Wow, I think technology story is very juicy. But don't forget about in Singapore, we still have the dividend play like the S-REITs. In fact, I have been talking about the S-REITs in Suntec since reopening in 2023. And last year I have the least pressure thanks to the restart of the Fed cut. And I also do believe a lot of investors already benefit from this S-REIT rally on the back of this REIT cut cycle. But today, I would like to share that how the investors could continue to benefit further S-REIT rally using an ETF vehicle. So this is our S-REIT headwinds and tailwinds for the year 2025 and 2026. And now, as we enter the year 2026, we do believe a lot of headwinds used to prevent from the S-REITs from the further rally. Now they are turning into tailwinds, such as the inflation, such as the cost, and more importantly, such as the monetary policy, because now they are all of them are more favorable than the previous years. But there's still one item which is outstanding, which is the economic growth. We're still facing some uncertainties. And if you look at the chart on the top left, if you read the absolute growth number, it doesn't look bad in the next 2 or 3 years, but it's already getting slower versus the year 2024 and year 2025. This is mainly because, as shown on the top right, the exports growth, they're still volatile on the back of the tariff uncertainties. But there's still some good news. For example, as shown on the bottom left, the inflation, although rebounded a bit in recent months, they are much, much lower than their previous peak in the year 2023 and year 2024. And this implies or supports a Singapore central bank, the MAS easing, as shown on the bottom right. As you can see, start from the beginning of year 20, maybe or even mid of year 2024, the Singapore funding rates, the SORA, it's already getting lower and lower and much lower than their US peers, which means the Singapore interest rate is already decoupling from the US interest rate, which in turn benefit the S-REITs because most of the S-REITs, their funding currency or their funding source is in Sing dollar instead of the US dollar. And the Fed cut provides some additional boost, like what we saw in the last quarter last year. But even for this year, the investors, they still expect some rate cuts. Of course, they have a split view. Someone may just expect one time of cut. Someone even expect, let's say, 2-3 times of the rate cuts. But there's one thing I think everyone should agree. If you look at the dots, the Fed dots on the right-hand side, the interest rate is still on the downward trend instead of the upward trend. So that is good enough for S-REITs to get the cheaper funding over time in the next couple of years. And the lower interest rate have 2 implications to S-REITs. First one, if all else equal, then the lower discount may imply the price rally. And second one, I think is more important because the lower interest rate will finally translate into the lower funding cost or lower debt cost of those S-REITs. And if we combine this with the still reasonable leverage or reasonable debt to asset ratio of the S-REITs, this will encourage the S-REITs to conduct more value-add M&A initiatives as well as the asset enhancement initiatives. And if we read the Q3 earnings, I think overall it's still okay. And here, green colors means the the good result. Yellow is okay result. Industrial, retail still leading the way. Industrial also benefit from the AI boom because when we talk about the AI boom, the most direct beneficiary is actually the data center REITs because they need to spend more money in the infrastructure and also to increase their calculation power. And retail REITs, because in Singapore, retail REITs have both the cyclical and defensive features. So that's why retail REITs are still quite okay. And this is followed by the office REITs. Of course, we can still face some growth uncertainties, but grade A offices, like here, like the downtown area, Raffles area, there is always demand, but the supply now is well under control. That's why office REITs are still quite okay. And the only outliner is actually the hotel REITs, because after the revenge spending following the reopening in year 2023, 2022. Now the supply is too much versus the demand, which put some pressure on the office REIT sector. But overall speaking, as shown on the top left, the sell side, the investment banks, the brokers, their average rating for the S-REITs are still quite high here. The higher the score, the higher the outlook for those S-REITs. And overall, the average occupancy is still quite good for the S-REITs across sectors. And more importantly, the average borrowing cost now is getting lower, but the gearing are still well below the MAS regulated those hard lines. So that's why there's still room for those S-REITs to rebound. And we still believe that given the current low interest environment, the S-REIT earnings upgrade cycle can still be expected, such as the DPU uplift, mid-single digit growth. But it seems still not be fully priced in the REIT market, because last year, most of the pricings on the REIT cut, but instead of the earnings upgrade. But now this year is a good time to reconsider the earnings upgrade, which can drive the further rally. The reason is quite straightforward, because we have the interest rate tailwinds, but also has a very stable S-REIT operating results. And the low interest rate can also reignite the capital market activities. I think the reason is also quite easy to understand, because now the average cost of this capital is on the lower end of the acquisition range, which means the REITs can earn more or higher returns on their new properties acquired than their cost, because the potential yield is higher than their the yield as reflected in their cost. That's why if you look at the table in the bottom right, even starting from year 2025, there are more and more M&A transactions within the S-REIT investment universe. And also, it's worth noting that although last year S-REIT already rebounded by maybe 15 to 20%, but the current valuation is not stretched at all. And if you look at the price to book valuation, it's just traded at around 1 multiple. So which means there's still room for further rally for the S-REITs. And additionally, the MAS, the initiatives, the EQDP, to increase the liquidity for the so-called non-STI stock members, can also narrow this yield and the valuation gap between the large and mid-cap S-REITs. Because when we talk about STI, the largest, maybe 20, 30 names, they include the bank stocks and the largest REITs. But when we talk about the next 50 names under the current EQDP program, around 30 to 40% is actually consisting of these relatively large and mid-cap S-REITs. So they are the main beneficiaries, including the Suntec, and also we are here. And this one is the DBS Singapore property clock. I really like this clock. In addition to residential outlook, we do believe the office REITs and the industrial REITs can still benefit from the current favorable supply and demand dynamics. And as I mentioned, industrial has an additional boost from the data center REITs. And looking forward, the retail REITs may be a bit mixed. The Orchard malls should be okay, because the tourists may spend more in the next couple of years. But the suburban malls, they may subject to some risks, because the RTS is going to open soon. You know, a lot of people, Singapore people, they may go to the JB to spend their money. I think I need to, even for myself, I may also consider drive to or take the RTS to JB. So that's why the retail outlook is a bit mixed. And for hotel, like the earnings show, the supply spike still puts some pressure on the hotel's risk outlook. And it's also worth noting that over the past several years, the high for longer, or the previous high for longer environment, they used to benefit the banks a lot, the 3 big banks in Singapore a lot, because their net interest margin benefit from this high interest rate environment. But since the interest rates start to turn, we believe the dark blue line, the REITs performance, is expected to narrow versus their bank peers. This this means that even the banks may still be resilient from the other business channels like the wealth management. The S-REITs is more of a direct beneficiary from the current lower interest rate or rate cut cycle. And sometimes we were asked to compare the S-REITs versus the other core asset class. We typically have the investment exposure. But I think as shown on the left-hand side, it's quite obvious that on the back of the current lower rate environment, the S-REITs dividends are still quite attractive at around 5.5%, which is higher than the STI, higher than the Singapore risk-free rate, higher than the Singapore deposit rate, and also the inflation rate. And more interestingly, if you look at the chart, the scatter plots on the right-hand side, the green, maybe diamond on the left-hand side, these high dividend versus the regional peers, equity peers or rates peers, is achieved through a relatively low volatility. This means their return risk ratio is quite attractive. You can harvest the 5.5% yield, but your volatility is just around at 8%. It's not a high volatility. And REITs, of course, can also act as a good inflation hedge. And the reason also quite straightforward, because for the rental fare, it's also a key component of the CPI. And for Singapore leading S-REIT names, they can easily pass their cost to the end tenants or even the end consumers. That's why if you look at the time series, although the inflation looks a bit sticky, but the dividend, as long as the dividend yield can continue to grow or at least stable, they can still beat the Singapore inflation and even the global inflation. So to help investors to capture these S-REIT broad-based beta rally, and our CSOP ETF using this Singapore IH S-REIT Leaders Index, I will not read the line by line for this index methodology, but in simple words, we include 22 largest and most liquid S-REITs in our portfolio, and through a half-year rebalancing and 10% single stock cap, we tend to capture the sector rotation every half year. And now, if you look at the chart on the top right, the industrial REITs, together with the data center REITs, still dominate our portfolio because, on the one hand, they represent some defensive features. On the other hand, they also have some growth potential thanks to the AI boom. And this is followed by the Grade A office REITs, as well as the Singapore domestic retail REITs. And as shown on the bottom right is our market exposure. Of course, all the 22 S-REITs are listed in Singapore, but their underlying business or their property projects can be beyond Singapore. As you can see here, nearly 60% the project is in Singapore, and the rest 40% are in Asia-Pacific region or even in the global region. And this is very important to those all the S-REIT investor. This means that investor can get the growth potential across the globe, but your individual withholding tax is still zero because they are S-REITs, so you are free of these tax. And here is the top 10 holdings of our ETF index as end of early January. We are not afraid disclosing this because we disclose this on the daily basis. And as you can see here, top 10 holdings account for 80% weight. But what the investor, as shown on the right-hand side, the investor behind are mainly the sovereign investors like the Temasek Holdings and also the property sponsors, as well as the largest asset managers. So these imply that the underlying REIT investment are safe and may have a better pipeline to conduct business and even a more reasonable debt structure because their relationship with those banks and borrowers and lenders. And if I suppose I stop here, some investors may ask that since S-REITs are still popular and attractive, why don't you directly buy them? I think it's nothing wrong to pick the single stock, single S-REITs, if you have the high conviction, but you may be subject to some concentration risk or the liquidity risk, and your yield, if you invest in the single REITs, it can be also volatile. That's why an ETF can be in place, because a weighted average S-REITs in the basket, they can provide a very stable but still decent yield number. For example, our SRT listed on SGX since November 2021, the average dividend yield is around 6%. And in recent times, although the Fed continues its cut, the S-REIT SRT dividend yield can still traded at around 5.5%. So this is still quite juicy pickup versus the Singapore 10-year yield, which is traded around 2%, which means the pickup is around 350 bips. And second reason, also easy to understand, because although every REITs, they traded on Singapore, but their underlying sector exposure is different, their underlying market exposure is different, so their correlation is obviously less than 1. So this low correlation, when we create this in a basket, it creates a much lower volatility than all of these underlying single holding. This could lower your all portfolios volatility, can also lower your drawdown, so to reduce your risk in aggregate. And highlight 3, I think, is even more important because sometimes it's not hard to copy our basket on our website because we disclose it on a daily basis. But the trading cost is hard to replicate. If you directly trade it on Singapore Exchange, individual investors may be subject to a much, much wider bid-ask spread, as high as 50, 60 bips or even higher. But since our ETF, we use our dedicated investment trading desk, we have a strong relationship and pipeline and network with those equity brokers, their counterparties. So we can trade the underlying REITs with a much, much cheaper price and translate into a much, much tighter spread on the S-REIT ETF. That's why we should use an ETF to copy the basket instead of using our own investment. And here is a snapshot of our product. Of course, all this information can be found on our website. And now our ETF's AUM is already around $130 million. It's already a historical high for our ETF. But to easily remember some of the key features, I think the next page can be even more useful. This is a Q&A format. First, what is the SRT dividend yield? The indicative yield is around 5.5% annualized for now. And what is the dividend payment frequency? Now it's twice a year. January and July. The next ex-dividend date is actually next Monday. For those who have not invested, you may already miss that dividend ex-dividend date. But the good news that after Monday, you can restart to accumulate the new round of the interest. And what is the fee of the SRT? Now, the total expense ratio is capped at 60 bips, which means regardless of the fund size, the total expense will be capped at that level. And what counter is available? SRT is obvious for Sing dollar. SRU is for US dollar. And minimum trading lot, quite friendly. 1 unit, around Sing dollar 0.8 at the current stage. And even for the creation redemption option, it's not super high. It's just 50,000 units or close to Sing dollar 40,000. It's not a very, it's not a very hard limit even for individual investors if they want to do the creation redemption instead of the SGS trading. And how to compare this product to the peer ETF on SGX? I would say our SRT is trying to provide a large and mid-cap focus to capture the market beta growth and also create a liquid, a tradable underlying together with the zero withholding tax, so to save the investors' cost. And Sing dollar or US dollar, I think the easy question is that if you have Sing dollar, you use SRT. If you US dollar, you use SRU. But if you take certain views for the FX, like last year, when the Sing dollar appreciates versus US dollar, then you use US dollar to invest in this Sing dollar denominated SRT. Then in addition to the capital gains, in addition to the dividend yield, you can also benefit from the FX gains. And as directly compared to those peer ETFs, I would say our SRT have the highest indicative dividend yield, but our PB are still fair at the current stage. And since we tend to capture the largest and most liquid names, which means we are quite sensitive to the market movement, this is a double edge of the sword, which means if you're during the market downturn in year 2022 or in year 2024, then our ETF will also suffer. But now, since the market is in the bull market, then we tend to outperform our peers. Like you can see in the bottom left, during the months with the positive returns, we tend to outperform our S-REIT peers. And this is also echoed by an even stronger rebound since the week of Liberation Day, April last year. So we can easily capture this market rally or the beta trend for these S-REITs. And for the last slide, the SRT performance, although last year 15% rebound, this year to date means the 2025, we still believe that the S-REITs rebound is not yet coming to an end. So we still have another maybe 5 to 10% at least room for the S-REITs rally. And more importantly, if you look at the tracking difference, the relative performance, gross of fees, we outperform our benchmark by around 50 bips, which pretty much offset our total expense ratio, which is around 60 bips. So investors can easily access this S-REIT market with a relatively cheaper cost. So that's all for my presentation today, and hope everyone can earn more through investing in S-REITs. Thank you.